The following is a presentation of TFNN. It is now time for the Diagnostic Trading Hour with your host, Darrell Martin. Now, Darrell Martin.
All right, folks, how's everybody doing today? Got a great Tuesday here, and market's just sort of interesting, right? Like watching paint dry in a lot of the markets across the board there. And that is a perfect time to trade binaries. So anyways, if you have any questions, give me a call, 1-877-927-6648. And if you're outside the U.S., give us a call at 727-446-1044. And, just to look at the markets right now and where they're at, I mean, the S&P, up, down a few points. The entire day right now it's down 3.75. The Russell looks like it's down 3 points as well. You got the Dow down 23. Oil is down to $1.94. It's had a bit of a decent move today. And, natural gas, just flat for the day so far. Not a big move there. And corn doing a little bit of a pullback from yesterday's big up move. And when you have days like this, and you can expect days like this, whenever we have announcements like the Fed funds rate coming out, earnings season basically is wrapped up. Yeah, there's a bunch of small names, small companies coming out, but the big players are mostly done. So, now the market is literally just waiting and seeing and trying to see what's going to happen next. And, everything's sort of based on what's going to happen tomorrow. And tomorrow we're going to have the Fed funds rate announcement, and they'll do their whole, spiel, and everybody's going to analyze every single word and look at everything that they said to get any kind of idea of quantitative easing. The real expectation tomorrow is that they'll basically do one simple thing, and they'll basically say that they're going to keep interest rates low for an extended year. So that's probably about all we're going to get out of tomorrow. However, it is expected that if unemployment continues to remain low, and if we see any kind of shock in, inflation, and they're going to have two more unemployment reports before the September announcement, that on September 13th, 14th, when they come out with that new announcement, that they could be looking at a QE announcement at that point. So that's really when the QE announcement, if it's going to happen, that's more when it should be expected. Tomorrow would be an insane surprise. Really just the expectation that they're going to say, hey, we're going to extend rates for one more year and, continue to monitor market activities, because there hasn't really been a big market fall recently for them to totally justify it. Of course, the GDP's been horrible. And there's a lot of things going on, but they'll say there's a lot of factors outside of their control. They won't factor in food because they'll say, hey, it's just a momentary spike in price, and, we're not here to control the inflation of food. We're just here to control, inflation that, on big-ticket items, I guess. It's really crazy. They didn't include food and energy. So, don't be expecting some big Fed funds wow moment, but that one-year announcement could come at a good time. It could be enough to push the market up. And, as soon as that's announced, of course, we got the unemployment non-farm payrolls coming out that morning before it as well. So you should see a big move, and then you should see it go flat, really, until the announcement comes out after the big move. And then, we'll have another big, we have more announcements, unemployment games on Thursday. We'll have the unemployment rate on Friday. And then we're also going to have the ECB making its press conference on I believe it's 7:30 Central, 8:30 Eastern on Thursday morning, sort of announcing what their big plans are. And nobody expects them to have really much of anything because they're really on hold until September, when the German Supreme Court decides whether or not the German people should take on all the liability of all the other countries. And then, of course, we have our debt ceiling also happening in September. So with the Fed funds rate, and you have the German Supreme Court decision, and you have the debt ceiling, debate, all that stuff, literally all culminating in the exact same week coming up in September. So keep that week on, your calendar there. Make sure you are aware that it is coming, and be ready for it so you can take advantage of it. And that's basically going to be the week of the 10th through the 14th. So the first few days not being real active, and then the next few days quite a bit happening, and then, of course, even rolling over into Sunday and Monday of the following week. So really 13th, 14th, 15th, 16th, 17th, and a couple of those days being, the weekend. But that's when the Supreme Court decision is expected to be announced, is on the 15th of September. So just, keep that, like I said, in the back of your mind. In the meantime, we're at major areas of, resistance right now. And It's just hovering right there, and everything is waiting to see again what the Fed says, waiting to see what the ECB says right after that, waiting to see how the unemployment reports come out, how the non-farm payrolls come out. So Wednesday, Thursday, Friday expect some movement. But what do you do on these days, like yesterday and today, where you don't have much of anything? And I mean, you look at it, we had a little bit of a spike in the morning, so right when the market opened there. But overall, I mean, there really just wasn't much going on. And how can you profit in markets like that? What are some of the things you can do? Because spreads, the box spreads on Nadex, and we're always talking about Nadex on the Diagnostic Trading Hour here as a way to manage your risk and maximize your leverage and help you be a step ahead of the market. And if you want a Nadex account, if you don't have a Nadex account, make sure you go to tfnn.com and go right there and then just click on the Nadex banner. That way you can sign up, you can get a Nadex account. You can literally have one in the next 15 seconds on the demo account. You just click create account. Right under the start button, you create a demo account. And then it's only $100 to fund a live account. And they're basically the same except for to get the most accurate bid-ask, size, and price, you need a live account. But because other traders in the demo platform would be entering trades that could mess that up a little bit. But once you've done that, and once you've logged in, you'll be able to log into your Nadex account, and you'll be able to see what's going on over there. And again, if you haven't done it, definitely this is a good time to check it out, play with it. And not only can you use it for the volatility, because you can use binaries for volatility, you can use bull spreads for volatility, but bull spreads really are not so much for flat markets. Bull spreads are really for markets that's moving. Now, whether it be a volatile day, an up day, a trending day, it doesn't have to be even a fast moving day. Fast moving day, slow moving days, as long as they're moving. Those are what you're really wanting on the bull spreads. The binaries, you don't have to have a lot of movement to get a lot of volatility in the underlying binary. And so whenever you have these flat days where the market is just barely trickling along, and the days that you should expect that, again, are days before things like the Fed funds rate, and even the morning of, after the news announcements are over. So if we go over and we look at, okay, what are the news announcements going to be tomorrow? And we pull those up overall. I like to pull them up on Forex Factor. It's a free site. And I go in and I look at tomorrow, and I can see on the U.S., we're basically going to get the ADP non-farm payroll right there at 7:15, 8:15 Eastern. And so that's going to get out. We're going to get the ISM manufacturing PMI is going to come out at 9 o'clock Central, 10 o'clock Eastern. And, we've got a couple other small things happening, but, nothing that's going to be really huge until 1:15, 2:15 Eastern when the FOMC statement and Fed funds rate is released. That's going to be the big item right there. So what are you going to do after the ISM comes out and before the FOMC statement? How can you take advantage of that? Well, you can go to the binaries, and just looking at the binaries right now, we can sort of see a range right here, and we're sort of making, I guess you could say, a new low, 1374, and then, up on the high of the day, since the market's opened here, we got a high of around 1383, and so go over and you can look in your Nadex account, pull it up, and look at indices, binaries, and then you can choose whichever indice you want to check out. So let's say we want to look at the US 500. And we can look at, usually you want to look at the ones that are going to be expiring sooner, so you can go in and you can take advantage of that. And so we got the, we got the 12 to 2, we got the 1 to 3 coming up on the 1 to 3, so that'd be expiring at 2 o'clock. You want to find ones that definitely give you a good edge. So 1 to 3, you'd be looking at if the market stays above 1372, then you would be able to profit by selling the binary. And again, the way the binaries work is they're a true-false statement. If you buy it, you're saying true. If you sell it, you're saying false. So true, being a buy, would be that you think the S&P is going to be greater than 1372 at 3 o'clock, okay, Eastern time. And all times quoted on the Nadex platform are in Eastern time. And false would be you saying that you think the S&P 500 is going to be less than or equal to, that's important, or equal to, all right? Less than or equal to 1372 at 3 o'clock. Why is it or equal to? Remember, it's true, false. The true statement is saying greater than 1372. Therefore, false is less than or equal to. So if I wanted to place this trade right here, and on 1372, I would literally click buy, and I look at it and go, hey, do I think it's going to stay above 1372? If I do, then I can go in and place that trade. Now, understand, the trade is going to have a higher risk usually when you're doing a premium collection strategy, okay? It's going to have a higher probability and a higher risk. How does it have a higher probability? Well, the market has to be below that price. Okay, has to be below 1372. And if it gets down to 1372, then, you could if it's at 1372.1, then you will profit. But if it's lower than that, then you would lose. But if it goes up, if it stays flat, if it moves down, 4 or 5 points from where it is right now, then you will profit. And so you can put that trade in. Again, this is premium collection. So sort of think of it like an iron condor on one side, or vertical spread on one side, in the sense of you're collecting premium, but you're trying to ensure that you're able to have a high probability in your favor. So we'll go ahead and put that trade on, put that in there. We'll place order, and we can also do it on the other side. So on the other side, we got above 1380. So we can go in and put that order in now. And if we do that, so let's say we put in 5 of them on that side, then we can also have that profit potential of $100 coming in. And again, you really want to do this when you expect the market to be flat. Okay? So when you're expecting really little to no movement in the market, that's when you want to do the premium collection strategy. When you're expecting movement, that's when you're going to want to go in and basically be making it where the market has to move to a certain price. Now, other strategies that you could go in and you could do is you could look at areas like you could go in on this $23 one. It's $23.50 right now that you collect if it stays below it. And you could say, I'll do it if I can do it for $50. Okay? And that would give you a 1-to-1 risk-reward ratio, because every binary, all right, every single binary is worth $100. So if every binary is worth $100, whatever your risk is, your reward is the difference between that and 100. So if your risk is 50, then your reward is 50 per binary. So that way, as these binaries become volatile, and they become very volatile in the last about hour or so, then you could go in and you could take advantage of that, and then you have, a good risk-reward ratio, and all that plays together. And you can flip around, you can do the same thing on the other side. You can put in an order for 5 of them, to do 50. And so that way, if it does pop down for a second, fills you, and then goes back up, you can actually take your profit off early. And so that order will become a working order, and you'll see that down in the working orders section. Now, once you have that down, you can look at the ones that are going to expire sooner. Like these are going to expire at 2 o'clock right here. And you can always refresh, make sure you're seeing the most current spreads, okay? And the refresh button's right there at the bottom on the left side in the Finder tab. And so 2 o'clock or 1 o'clock Central. And if you check that out, you can look at that and look at, what do I think there is that I might be able to do something with. Right now the market's right at 1376.3. So let's say you think this is a very solid resistance level, okay? And you think the market is going to finish above 1376.3. Well, then you can go in and you can buy this. Right now it's $56 to buy it. So that's the risk is $56.50. The profit potential is $43.50. So with that in there, all that has to happen is it has to stay above 1376.50, and you'll be able to profit on that trade. Okay? So, or 1376 actually 0.3, and you'll be able to profit on the trade. So we place order on that. And so that's a few examples on the US 500. We'll go over and we'll check out a couple other markets when we come back from the break. And give us a call if you have any questions, and we'll stay right there, and we'll be right back.
Kate Stalter's exciting newsletter, Low Priced Leaders, has just launched, and now is a great time to get a 2-week free trial. Every Wednesday afternoon, Kate sends out her weekly newsletter to her subscribers, where she focuses on small cap stocks with market caps under $2 billion, as well as low-priced equities with share prices ranging from $5 to $12. Kate tracks a variety of stocks with a combination of strong technical support and solid fundamentals. Many of the stocks featured will be recent IPOs. These newer issues are often some of the biggest price gainers in the market and provide an excellent opportunity for substantial gains if timed correctly. You can catch Kate Stalter live on Tiger TV with her Small Cap Roundup every Tuesday and Thursday at 11 a.m. Eastern Time, and visit TFNN.com right now to get your 2-week free trial to her brand new newsletter, Low Priced Leaders, while locking in the low introductory monthly rate of only $37.50 per month, almost a 50% discount. Act now.
With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, Kate Stalter, David White, Larry Pesavento, Victor Jones, or Darrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
Millionaires are made every day. The fact is, living your dreams is possible. Someone, somewhere is going to get rich. My recommendation is, let that be you. Each day, someone is making the decision to better themselves and creating a plan to fulfill their financial dreams. Let that be you. The key to turning dreams into reality is to take massive action. Let that be you. I'm Steve Rhodes, co-host of the Money Master Show with Tom O'Brien, seen daily at TFNN, and I can help you with your journey to great wealth. I'll show you how to create the ultimate financial edge, a set of tools, insights, and strategies that are part of my daily newsletter service, Mastering Probability. You'll have direct access to me by phone, email, and my private library of trading and investing secrets for 30 days with an unconditional money-back guarantee. I'll take your trading to the next level. Click on my name, Steve Rhodes, on the homepage at TFNN.com and turn your dreams into reality. Mastering Probability, folks. Let that be you.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows. Plus, see all the charts as they happen live during those shows and have access to archives of those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
All right, folks, welcome back to the Diagnostic Trading Hour here. And we're talking about binaries and bull spreads and how to trade in both flat and volatile markets. So right now we want to go, and I was looking at just a couple markets today. One of the things I wanted to look at was, we have a flat market, of course, today in the S&P and in the markets just while they're waiting. And just, basically a wait-and-see game to see what the Fed is going to say, to see what the ECB is going to say. And when you're in those waiting games, you want to look at binaries. And you want to put binaries instead of a expected move. You want to more look at the, maximum expected move. Try to, get outside that range and collect some premium along the way. Now, on the flip side, you could look at markets that are moving, like CL, like oil. And so if we pull up oil, and we just sort of look at the chart on that and see, what were the possibilities today? And it really just did a perfect, nice, trend this morning, and just moving down really solid. You can check it out right here. Basically yesterday, made a move down, went a little bit flat, and then just dropped, came back up, dropped again. So what could you have done this morning? How could you have traded oil in doing that? So if we go and we look at the commodities, and whenever your market's moving, my favorite is usually to go in and look at the spreads. And so if we just check out, say, the daily spreads on oil, so that's under commodities, bull spreads, and then daily spreads on oil, and we can check out, usually there would be the 1,000-point wide one. That's going to be the $1,000 spread, okay, and is the maximum value in that spread. And usually you're not going to trade that one because it's usually going to be somewhere in between the middle and like right there in the middle of the floor and the ceiling. It's not going to give you necessarily the best risk reward. The one advantage to it is you could use it to trade the underlying without really having much of any premium built in. But you may want to go down and look at, say, the dailies. On the dailies, there's a couple different ways that you can trade them. And one of those ways is you could look at the one that has the lowest risk based on where the market's at. So if we look at where the market was this morning and we're checking it out, and it's floating right above, right around $90, just up and, down on $90 there, right as the market was looking to open up this morning. And, right as the market did open up, we see that, oil was right around 89, 60 or so. And just depending upon what minute you're looking at it. So if we're looking at that, then we go over and want to find the one with the closest ceiling, okay, if we're looking to go short on the market. So the market's going down, we go in and we look at it, and we pull up a chart and we see how the oil spread contract actually resembled the market. And so by pulling that up and looking again at this morning right here, as the markets open up, we're getting 89.60 or so. So very similar, very close price there. You're able to take advantage of, and then you're able to write it down as it moves down. So what would happen if you actually sold this spread at 89.60? What would have been your risk? What would have been your profit potential? So if we go in and we just do one spread, and we put in the price of 89.60, we can see our risk is $40. Our profit potential, if it goes all the way down to 85, okay, is $4.60. Now we can get out at any price between here and there. We don't have to wait until it gets down to 85. And it's not like a binary. Okay, binaries are true-false statements. Spreads are really just, up, down. All right, so it's just like trading oil in the sense of you're selling it, and if it goes down, you make money. If you're buying it, it goes up, you make money. That type of thing. Okay, so if we sold at $89.60, we have $40. Let's say we do 10 of them. All right, so 10 of them would be like doing a full oil futures CL contract, and that'd mean that every $1 move would obviously have a pretty large value to it. So what it would do is it give you every tick would add the value of $10. So a $400 move is really, that's not that much. That's a 40-cent move in oil, okay? So looking at that right there, that's what we're looking at. We have a $400 risk on the trade, and we put that in. Where would we be at right now if we would have sold it at that price? So if we would have sold it at $89.60, okay, and this morning, and that's not picking the high. That's just about where it was at the market open after it started moving down there. So sold it at $89.60, and then let's say we bought it back right now at $87.85. Okay, we'd have 175 ticks, okay, of profit, and $10 per tick, $1,750 in profit this morning with only a $400 risk, over a 400% return on your risk. So great risk-reward ratio, and that's if you closed out right now. You also could hold it longer, but you may decide, hey, the market's starting to go a little bit sideways. I want to take my profit, or maybe just close out half of your position. If you close out half, and let's just say it retraced all the way back up, then you still would come out, basically making $800. You'd still would have made double your risk, and you have the position right now, if you closed out half, to let the rest of the profits continue to run if oil does continue to drop. So, definitely look at those on markets that are moving. Look at those spreads. You want to find, again, the spreads that are close to the ceiling when you're selling, because that'll give you a lower risk. Versus whenever you're looking to buy, you want the spreads that are close to the floor. And if you ever get confused about floor and ceiling, the left side right there, the lower number is the floor. The higher number is the ceiling, okay? And even when you click on a ticket, it even tells you what the ceiling and what the floor is inside the ticket itself. So all you got to do is click on a ticket. It'll open up. It'll tell you the ceiling. It'll tell you the floor. It'll tell you the risk, the reward. Everything's there for you. You don't have to do any of those calculations. So definitely check that out. And stay right there. We'll be right back after the commercial break.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. Would you like a personal update from Tom O'Brien as to what equities he's trading and what his daily trading plan is before the market opens each morning? Every market day, Tom O'Brien sends out his daily newsletter, Market Insights, to hundreds of subscribers that rely on his daily recommendations when it comes to navigating these highly volatile markets we're dealing with. As recently as May 21st, Market Insights subscribers closed out all 5 open positions for a combined profit of over 68% in one day. Profits ranged from 6.5% to over 24%, and all of these trades had been initiated within the previous 30 days. Now is the perfect time to get a 2-week free trial to Tom O'Brien's explosive trading newsletter, Market Insights, an $85 value. Tom breaks down the market each morning with his market take and provides trade recommendations including precise stops and target profit zones, leaving nothing left to guessing. Log on to tfnn.com today and sign up for your 2-week free trial. Make sure you're a subscriber the next time Market Insights subscribers close out multiple winning trades. Take action and sign up for your free trial today. If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of tfnn.com and sign up now.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Smith Barney. Simply picking the right stocks is not enough. Research has shown that choosing the right proportion of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley Smith Barney believes that a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what asset allocation and a Morgan Stanley Smith Barney financial advisor can do for you. Call Angela O'Brien, First Vice President and Certified Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Smith Barney, LLC. Member SIPC.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
All right, folks, welcome back to the Diagnostic Trading Hour here with Darrell Martin. And we're just looking at several trades, several possibilities of things that you could do to take advantage of the markets when they're flat and when they're volatile. So, obviously we have the indexes right now being pretty flat, and we have several other markets such as the, as the energies like oil are being really volatile today. And, oil has moved down right now of over 2%. So, $1.90 moved down. And whenever you're trading, of course, if you're trading futures, that's one of the big things that can become difficult is you have a lot of leverage. You only put up a little bit of money, and you control a whole lot of money. So what can you do to best put that in your favor so that way you can limit your risk but still take advantage of that leverage? And, if you look at oil and you're trying to figure out, what kind of leverage am I really getting on, say, Nadex with this? Well, the trade that we were looking at earlier would have been a $400 risk, and your margin and your risk would be the same thing. So if I'm only putting up $400 on a product that at that time cost around $89.60, and I go in and go, okay, well, multiply that out. Every tick is, basically that's 8,960 ticks, right? And then I go in and say, okay, well, every tick is worth $10. So it's an $89,000 product divided by 400. So that's a 224 to 1 leverage. So massive leverage, but the leverage only cuts in one direction. Because if you're trading, let's just say you're trading futures, you're putting that money up either way. You're putting up more than $400 to trade an oil contract. So you're probably putting up somewhere around $1,000 to trade an oil contract. So you're putting up twice the money, and that's just for your margin. Okay, when you're trading a futures contract, not only you put up $1,000 for an intraday trade on a full oil futures contract, but you also got to have the floating P&L. So if you have a $200 or $300 or $400 drawdown, then you have to also have that additional money in your account. Okay, and usually they want you to have like a 2-to-1. Not using basically a set of percentage, ideally, of how much margin you use in your account at the same time. So when you put all that together, you're actually getting lower leverage, okay, and more risk with no cap by using an outright oil contract. And, and some of the people, the only excuse I ever hear from people, I only hear two things about wanting to do something besides like oil versus outright Nadex. One is people come in and they say, well, I just want to scalp. I want to go in for short moves. And so I don't want to have to deal with, premium, so time being in there. And that really isn't an issue. All you got to do is pick the spread that is right around the money of the current price. So you can go in and you can, look at several different spreads right now. And like the one right here, this 87.25 to 88.75. If you're going to have for a short move, well, oil right now is quoting at 87.90. So it's right there in the middle on the quote. And so, that's a perfect scenario right there. You're not having to deal with the premium issue. And you're getting to take advantage of the lower margin requirement. And if you're going in and you're looking at this trade, if we pull it up, and let's just say either you're buying or selling, and you're doing 10 of them, then on that trade you would be putting up 700 versus say 1,000. Okay, and it doesn't mean you're risking 700. Now there is a maximum loss of 700. You could get out after 1 or 200. Now I like to get the ones near the floor or the ceiling because it lowers my risk. It gives me more profit potential. But with that, you may have a little bit of premium. Now, the other solution to premium that you can use is you can go in and you can put on one that's closer to expiration. So if you're going in for a scalp for a smaller move, then all you got to do is go and select one that is going to be very close to expiration. So as it gets closer and closer to expiration, all of them will start lining up and being at the same trade price there. So you can take advantage of that. And sometimes you can even collect premium depending upon what spread and what time you put the trade on. So definitely take advantage of that. Look at the spreads, look at the different ones, but don't worry about premium. There is a solution to premium that gives you lower margin and defined risk at the same time. And then the other reason is somebody says, well, I don't want to cap my profit. Now, I don't really know about you, but a profit margin, the profit margins that are available are huge and great. And if I go and I look at crude oil and I'm looking at the dailies and I'm looking at selling this contract up at this morning we're like 89.60, then I'm looking at a profit margin, update my size and my price there, of $4,600 potential profit on a $400 potential loss. So, meaning I can make money all the way down to 85. But there is a solution. Let's say you want to do what's called the open box. Then you can actually go in and you can do an open box strategy where you don't have any limit on the amount of profit that you can make, but you still get a very low risk. And so, and again, this is probably honestly my favorite strategy to do. We talked about this on the show quite a bit yesterday, is I'll go in and I'll buy. So if we're looking at oil and we pull it up and we look at this morning, like what was the spread priced at, okay? So this morning we go in and we're looking at, buying this oil contract right here, and oil, let's see, was about around, 9:30 Eastern there. When the open, 90.17 was the price of the spread, okay? And if we go in and we say, 10 of them on that, that's $170 risk on the upside on the spread. And if we go in and we pull, 9:30, let's see here, Eastern, so that'd be 8:30 Central. And we'll go in and get this right down there on the price. Then we're looking at around 89.55, 89.60. So it's like we were talking about on the last trade there that we're looking at. So the risk would be my difference between the two. Okay? So on this one, what I'm doing is I have a hedge, meaning this thing will make money for me all the way up to $95. Okay? And I have a $4,830 hedge. And I can go in if I want to, and depending upon where the price is at the time, the price is really lower than the spread, so it's not giving me, I'd say, the best risk reward on this particular example. But either way, if I go in and I look at 90.17 minus 89.60, then I'm looking at about a $570 risk, and I have absolutely no cap on my profit potential, and that's doing 10 of them. Okay, I could also do mini oils contracts and cut that number in half. So if you don't have any cap on your profit potential because you think the market is going to move, that amount, that's a $5 move. Okay, it's a $5,000 move in an oil contract. if you're worried about it moving that far, just combine the two together and do a hedge. And that allows you to trade oil like you're trading it now, but have the hedge on. And the really cool part about the hedge, probably my favorite part about the hedge, is when you go in and let's say you short oil and you have that long hedge on. When that long hedge is on and it comes down and you take off your profit on your oil contract, if the market reverses and goes back the other direction, you actually could end up making money on the hedge as well as on the underlying oil contract. And you can do this with any of the products on Nadex that are based in USD in their quotes, so like euro dollar, pound dollar, Aussie dollar, any of the commodities, and any of the index US indices. All those can be used to apply it to the strategy. So we're about to have a commercial break come up here soon, but when we do, what I want to do is I want to come back and I want to talk about some of the different ways that you could use Nadex products to trade the upcoming news announcements tomorrow with the non-farm payroll and with the Fed funds rate. So you definitely want to have a trading strategy in place and some different ideas on things that you could do with that. And it looks like we have a little bit longer for commercials. That's perfect. We're going to go ahead and hop right into it. So looking at the numbers right here, we're going to have what tomorrow morning? We're going to have the ADP non-farm payroll at 7:15, 8:15 Eastern. We're going to have ISM, all right, at 9 o'clock Central, 10 o'clock Eastern. And then we're going to go down and have the FOMC statement at 1:15 Central, 2:15 Eastern. So how do we combine these together? What can we do? All right, well, you can pick your favorite index. I recommend either the Russell, the S&P, or the Dow on Nadex. Those are the three out of the four. Not as big of a fan of the NASDAQ, just the way it ticks. I like the way the other ones tick a lot better. And just to show you what I'm talking about over here, if we look at the tick prices on the bull spreads, then what you'll see is like the US cap, the US 500 here is ticking in 0.1. Well, the mini is ticking 0.25. So it's actually ticking tighter, better than the full contract. So that actually makes the US 500 my favorite bull spread for all the indices. Next, we have US small cap. It ticks the same way, in 0.1. Okay? So tick the same. That's great. Go to Wall Street 30, and we're able to take advantage of the same thing. It's ticking in whole numbers just like the underlying market. But if we go to US Tech 100, one of the challenges here, whenever I'm looking at this contract, is just the way that it ticks. It drops off basically 1 point of movement in the tick. And so with that, I found that it's a little more challenging because the market does have to move further for you to really be able to realize any profit on the spreads on the US Tech 100. So it doesn't make it a bad product to trade. It's just for my personal trading style, I really prefer the US 500, the Small Cap 2000, and the Wall Street 30 on the US indices. So those three. And while we're on that subject, let's go ahead and check out some of the other ones as far as the groups. Really, any one of the forex pairs are great. I usually focus just on the dollar pairs, but if you're into pound yen, US yen, when the yen things are coming out, so that can be great. But any of the forex pairs are great. Commodities, my favorites on those are going to be corn, crude oil, and gold. Natural gas, silver, and soybeans. The soybeans seem too far away. The silver, the tick is just way too spread out, and natural gas, it actually does work pretty well. So natural gas is good. But corn, crude oil, gold, and natural gas. Silver and soybeans, I shy away from those a little bit. But, I definitely stick to the gold a lot. And you can use these to hedge. You can use them to outright trade. And now, that being said, that's about the bull spreads. The binaries, I like on all of the products. Okay? So I like all of the indices on the binaries. And I like all of the commodities on the binaries. So it really, again, is going to come down to your personal trading style and how you're trading it. But just to focus again in on the bull spreads, I like the US 500, the Russell 2000, and the Wall Street 30. So when the announcements are coming up tomorrow morning and you're trying to decide what you want to do, okay, then you got to go, okay, well, when is the spread going to expire? How much of a move do I expect? Okay, well, think about this. You got the ADP non-farm payroll. That's going to come out, and if that's going to be 8 o'clock Eastern, then you're going to need one 8 o'clock, Eastern time, a.m., then you're going to need one that's going to expire after 8 o'clock, okay? And probably 9 o'clock is going to be sufficient for your trade. So you're probably going to be looking at the 7 to 9 trade for the ADP non-farm, employment change. And you actually could hop in on the 8 to 10 non-farm employment change. So that might even be the trade you look at. Literally 15 minutes before the announcement comes out, I'll even update this to Eastern time, make it a little bit easier for those who are watching over on the Tigers Den there. And just make sure that, you pick the right spread. Make sure that you understand the time zone differences, because that can definitely affect you whenever you're picking the right spread. So you're going to want to pick one that expires after 8 o'clock Eastern. Don't pick one that expires right at it, okay? And so again, that's probably either going to be a 9 or 10 o'clock expiration on the ADP non-farm employment change. Why don't you want the all-day one? Well, that report's going to come out. Right after that, ISM manufacturing PMI is going to come out, okay? And then a few hours after that, FOMC statement is going to come out. And all three of these could have completely different impacts on the market. And, one could drive the market up, one could drive the market down, the other one could drive the market up. They can all drive the market down. And so that is an option that you have. You could go in and you could sell the dailies. And so what I want to, really get you to focus on is two things. One, either look at the daily contract, okay? And even with the dailies, maybe go in and do some 2-hour spreads, maybe even the opposite direction, like as a hedge, okay? So you go in and you sell the daily that's very close to where the market is. And but if you do that, you're going to have more premium built in, okay? Especially when you have big announcements like this coming out. The other thing is if you do the 2-hour ones, then you don't have to have all that premium. So 8 to 10 might be an ideal time. And then whenever the ISM's coming out, you're looking at one that expires at 11. Okay, so be looking at either a spread or a binary that expires at 11 o'clock. And then after that, the market's going to probably be flat for the next 4 hours. Okay, so at that point, then you're looking at binaries that are expiring really almost every hour. So like at 11, 12, 1, and even 2. So those 4 hours, you're looking at possibly making money on the binaries for those. So definitely look at, the binaries between 10 a.m. and 2 p.m. as far as, premium collection, okay? Meaning the market doesn't have to move at all and you can make money on it. It can move up, you can make money, it can move down a little bit, and you can make money or vice versa. So your whole strategy tomorrow is 2 hours on ADP non-farm employment change, okay, one that expires at either 9 or 10 o'clock, ISM, one that expires at 11 o'clock, okay, and then 11, 12, 1, and 2 for binaries to get some premium collection because the market should go pretty flat after the ISM's out. And then you're going to roll over and you're going to look at some spreads that expire at 3:15, or 4:15 Eastern time. And so those are the two that you're going to look at the end of the day, 3:15 or 4:15. You're also going to have the dailies at that point. And again, you may want to put a daily on, so if there's just a massive trend direction in the market, you can take advantage of that, but also take advantage of some of those swings just in case you do get some, pop-ups based on the announcements that come out. And so that's just directional. So you want to go in, you want to sell, you want to buy. All right? What about if you don't want to be directional? What can you do? There's two different possibilities. Actually, there's several different possibilities, but we'll go over a couple of them. One of them is you can buy and sell a spread. So let's say if the market, is at 1380 tomorrow morning at 8 o'clock Eastern, then you could buy the spread that's like 1380 to 1390, and you could sell the spread that's 1380 down to 1370. Let's say it costs you 2 points on both sides, and then so basically you have a 4-point risk. And if the market moves 4 points in either direction, it covers all your cost, and everything after that is profit. Okay, so that's one thing. Another thing is if you do that straddle, you could go in and you could actually take profit earlier. So if you do that and you go in and let's say, don't wait till to get all the way 10 points. You could let it go down, say 6 points, and you've made more than enough to cover all your risk, and you've doubled your reward there. And then if it pops back up on the other direction, or your risk, it pops back the other direction, you can make money on the other side of the spread. So that's a straddle version. When we come back, we'll wrap up with a couple other combinations you can do to be non-directional on these announcements when they come out tomorrow. Stay right there. We'll be right back after the commercial break.
You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor, Foreside Fund Services, LLC. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Put the power of the Chapman Wave methodology to work for you. No matter what market you trade, what time frame you trade in, or your trading style, the Opening Call, Basil Chapman's daily market newsletter, is bursting with the information and trades you need to become a more successful trader.
I've been using Basil Chapman's Chapman Wave methodology for several years now. His Chapman Wave can be used for any time period for not only equities, but futures, currencies, commodities. I've been also a subscriber of his Opening Call, which I find an invaluable tool to help me analyze the potential of the market each day. He gives you opportunities to go short and long. It includes recommendations on stocks. I strongly recommend people using the Chapman Wave, and I very, very strongly support the use of his Opening Call.
To find out more about Basil Chapman and his Chapman Wave methodology, and to get your 2-week free trial of the Opening Call, a $64 value, visit TFNN.com today.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the Rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
All right, welcome back to the Diagnostic Trading Hour. We're going to wrap up here. We're talking about several different ways that you can basically straddle the market, not be directional on the news announcements, but profit at the markets through move. And we obviously are expecting some moves tomorrow with non-farm employment, Fed funds rate, ISM, all coming out in the same day. So, with that in mind, we talked about doing a straddle, buying a spread above the market, selling a spread below the market, and also looking at a potential daily contract as well. Another possibility that you have, some other possibilities you can do, is you can go in and you can do basically a lever, like a ratio spread, you could say, where you go in and let's say on the S&P 500, it's 5 spreads to 1 S&P contract. You could do maybe 6, 7, 8, 9, 10 spreads and 1 future. So if the future does move far enough, it not only has the ability to cover the cost of the spreads, but make a profit. On the flip side, the spreads really could also make money as well. So, and their risk is totally defined, and they could make twice the amount that the future could lose. So since they can make twice the amount, that covers you, and since the future has the ability to make the money to cover the spreads, then that could cover you. So doing a ratio spread on your underlying contract, doing a straddle on your contract. Another way to straddle the market is actually straddling using binaries. So you could go in and you could buy the binary above and binary below where the market is currently trading at. And that could give you several possibilities of, the ability, like maybe you go in and you can buy the one above it and the one below it for $20. And then when it shoots up, you're able to close one for $50, okay? And that removes your risk. You only have $20 of risk left over there, so you have a $30 profit at this point. It's locked in, okay? And then if it comes back down, then you actually could close the other one $50 when it gets back to that strike. So if it moves up and down 3 points, which is when it happens a lot with the Fed funds rate, you can see the market move 5 or 10 points up and down multiple times during the announcement. So if you see that happening, then that's a great way for you to take advantage of that and go in and straddle with binaries. One other option that you could take advantage of is you could go in and you could actually do a hedge of a binary with a spread. So let's say you're putting on a spread and the risk is $50, okay? You buy a binary that's a few points higher for, let's say, $20, expiring at the same time. The market goes down, great. It covers the $20 risk and profits on the spread, covers the $20 risk on the binary. But if the market shoots up, then you only need to put $20 to straddle, okay? That binary makes $80 at expiration. So the $50 you put up plus the $20, and you get back a payout of basically $80. So you lost $50, you made $80, you netted $30 on the trade. So this is a way to sort of hedge yourself. And you could maybe even do 2 binaries instead of 1 binary. And on that scenario, you'd make $160 on a $50 risk on the spread itself, okay? So you can either combine the binaries together as straddles. You can combine the spreads together, one above and one below the market. You can combine a binary and a spread. You could do a ratio spread where you have more spreads than you do needed for the underlying market to equalize it, such as 5 or doubling that to say 10 spreads for one U.S. futures contract. So those are just a few different ideas to get your creative juices flowing and take advantage of what's going to go on. But we're not really looking for a whole lot to happen between now and then, so definitely take advantage of that. And don't forget about the binaries and how you can take advantage of that between the ISM and the Fed funds rate. Looks like right now we have several positions on that we put on during the show, and they're all profitable. This one's up 18, this one's up, flipping between 18 and 20, and the other one's at break even right now. Just as the markets continue to stay flat, they continue to collect premium. So we'll just keep watching those. And everybody have a great day, and we will see you on the show tomorrow on TFNN.com from 12 to 1 Central, 1 to 2 Eastern Time. Check out the archives under Tiger TV, and we look forward to talking to you then.